Tim, you saw some of the reports. You've seen Elon's story. What exactly does Wall Street, what exactly do economists think is the actual benefit or drawback from these initial budget proposals?
Well, first of all, talking about 3% GDP for the next 15 years is pretty extraordinary because the greatest economy of all time has never printed 3% under this administration. So if you think about the world we live in today, the reality is that and maybe this isn't germane to a long-term tax discussion, but GDP estimates are being cut for the United States as well, even though significantly less than the rest of the world. And if you listen to Bruce Kasman at J.P. Morgan, who I do, the global economy is going to be 1.3% in Q1. And so we know the headwinds from coronavirus, but I think the reality is projecting out GDP in the context of talking about really that $1.4 trillion tax cut holder billion-dollar tax cut holder is a very important dynamic for Wall Street. It's a very important dynamic for thinking about the markets and the construct of the current administration into a political season when the market hasn't priced in anyone but Trump at this point. So I think this is more fuel for at least the current environment where, with the Fed sitting where they are and the administration sitting where they are, it's Wall Street positive.
All right, $1.4 trillion reserved for tax cuts is certainly a big deal. We'll see if that can jumpstart any kind of the economy at this stage right now. Another big story for investors today, Tim, is the coronavirus. It has been for weeks and if not months now. China is attempting to get back to work in some way, although some businesses remained closed despite the government's efforts to restart commerce and industry following that extended Lunar New Year holiday. More than 900 people have now died from the virus, making the outbreak deadlier than the SARS epidemic back in 2003. Sources say Foxconn's factory in Shenzhen remains closed after Chinese authorities rejected its request to resume operations. Foxconn, remember, a key manufacturer in the supply chain for Apple. So is the economic impact right now on not just China, but the world perhaps being understated if the technology and industrial supply chain, Tim, cannot get back up to speed in a short amount of time?
Right, and so that's the question, Dom. I mean, what are we talking about? Because I think the status quo has a dramatic rebound by March. We know that February was probably worse than expected, and again, getting back to either estimates of the global economy, but looking specifically into the supply chain, we know we have significant disruption for February, and the timeline right now, I would say that stocks have priced that in. If you think about, in other words, they've basically shrugged and said we don't see a long-term impact. If you look at the performance of semiconductors, if you look at the SOX, if you look at the SMH, however you're tracking this, you can see that it's been very sympathetic on kind of the headline days, but that for the most part we haven't really seen the kind of a correction that tells you that people think this is anything more than a hiccup. I think if I think about my experience investing in SARS, investing in Asia specifically back in 2002, 2003, that's what people should do. And I think if you think about the context of global markets that were priced to perfection coming into this without this expectation and without a sense that this could be something more than, this has been a tragedy of global proportions, certainly in China, and we don't know the extent of it. But the expectation is that this is a short-term hiccup.
All right, and semiconductors as an industry somewhat underperforming the broader market, at least with the S&P 500, Tim. One more thing before we let you go. On Tim, because on this day in history, 2 decades ago, a little-known company made its public market debut.
We're coming to you from one crazy dog park. Now that you can get whatever you want at pets.com, it's like Mardi Gras. Don't give up.
Pets.com, yes, the sock puppet. That stock, Pets.com, surged some 30% on its first day of trading to more than $14 a share. Fast forward just 8 months from then, the stock would be at $1, and by November, the company would be out of money, would be forced to shut down. bankrupt. Take us back to that day, and if you see any signs of something bubbly or similar today, is it fair to call any part of the market today akin to what it was back in the mid to late 1990s?
Poor Pets.com. I mean, we do this over and over again, and it's a relevant comparison for markets that if you look at price to sales ratios or even PE ratios, we are back to those go-go days. You have a very different construct. Look, people that talk about the multiple of the S&P are able to show a lower rate environment and a lower discount rate and start to draw many different fundamental structural reasons why we could still be okay here. I think if you look at the earnings profile of Q4, we had a dynamic for some of the mega cap tech stocks that said, hey, a lot of these guys mostly beat on both the top and the bottom line, and they're certainly taking market share, and that you're actually seeing the core of the NASDAQ 100. And if you think about Microsoft, Apple, and Amazon, you have almost 30% of that. And those three companies actually probably warrant the multiples that they trade at. And I know that's kind of tough to say about Amazon. I think stocks are largely priced to perfection because central banks are able to do to markets what they can't necessarily do to economies. And we're going to go into a period here where we've already started to see the central bank reaction to the coronavirus. I think equities are going to continue to rally from this. It doesn't mean that I think that they should be disregarding the references to Pets.com and sock puppets. I think we have a case here where as long as the central banks are stirring this punch bowl, that's the issue. And look, on Wednesday, we have Jerome Powell with the semi-annual Humphrey Hawkins testimony. And I think we have to listen every time the Fed speaks, even though I don't think the Fed in the short run is going to be talking about taking away that punch bowl. Central banks are the reason stocks are trading at this level. We didn't have the central bank ingredient back in the dot-com boom. And I think investors need to think about that. That's the most important thing. And central banks feel as if they're supposed to support markets here. That's not my view of what they should do, but that is what they are doing.